inflation question. 10-year is at 2.5% round numbers. The 30-year Treasury is at 3% round numbers.
Why don't you ask this guy over here?
Well,
I'm just an audience member, you know. You guys are sitting on the
he
table.
wants to hear. So from a risk,
What is it?
chief risk officer, chief risk officer perspective, there's a lot of people who think that 3% is just fine for 30 years. Yet, every day we hear these growing loud drumbeat that we're going to have rampant inflation. So, if you're managing cash flows with that sort of interest rate model in mind, what do you do?
That really ties in very closely with the cash question and how you prepare to have enough liquidity to go forward. The two definitely need to be tied in, hand in hand. And while you need to think about the planning for increasing the liquidity and maintaining enough cash to be able to operate and fund future projects, you also need to be factoring in the inflationary rate. And I think that there's going to be outliers on that. It could possibly reach 20%, who knows? But you try and come up with a reasonableness factor where you put in let's just make up a number 10% over time, so that hopefully you're hedging a little bit against that as well and covering for the inflationary portion of it. That's what I would do.
So back to a stress or scenario test with a pretty big standard deviation.
I would think, yeah.
Other thoughts about?
Well, I think the expectation of an increase in inflation I can't imagine how it could not occur. And the reason it's not reflected in treasuries today, to the extent we think it should be, maybe it is, but to the extent we think it should be, is because today we're, and for the last number of months, there's been such an over-advice about not losing money, where the inflation in the out years has been more than offset by the need to not lose money today, and therefore the flight toward anything government issued. The capital markets have supply-demand dynamics just like the space markets or fundamental markets have. And there's a lot of capital looking for safety in treasuries. Well, treasuries just, the prices go up, the yields go down. So I think the yields are a reflection of the need for safety today as opposed to a bias toward not much inflation going forward. And when that reverses, and it will reverse, it's likely to be okay.